Welcome to Technical Tuesday. This is Fed Razak, Senior Trading Strategist here at CMTrading, and today we're starting a new series on oscillators. But before we start, make sure to like, subscribe, and do share, especially if you find value in this presentation. Okay, so oscillators are indicators that you can populate on your trading platform. Okay, on the MT4, if you go to the top of the tab and you go to and press indicators, you'll see the option to toggle down to oscillators, and if you press that, you'll populate a number of oscillators. Now, oscillators really come from electricity, okay? That's really where it's derived from. And if you think about it, it's like the electrical waves that you get, right? Those energy waves that carry a current, or the bandwidth, okay, that carries the current in electricity, okay? And that applies to trading as well, okay? So there's two really very important factors to consider when we're looking at oscillators. Number one is the bandwidth, okay? How far is it going from up to down, and how quickly, okay? The momentum in relation to it. Now, those of you who have seen some of my videos before know that those are two very important combination factors when you're looking at trading the financial markets. You need the markets to be trading on certain volatility, and you need it for it to trade within a certain time frame, okay? And those are the two very important components when you're using oscillators. Now, oscillators are mostly used for range-bound trading environments. Now, what is range-bound trading environments? It's basically when a particular asset is trading between 2 points, okay? It's going from $5, for example, to $10, selling off at $10, going back to $5, on and on, okay? And now these are relatively very common market conditions, okay? An asset will be trading in a range bound for about 2, 3, 4, 5 months, and they may break out, okay? But within that time frame, you have multiple opportunities to really trade that range, okay? Now, the other market condition that you could also use oscillators is a trending market where we're actually going on an angle, okay? Either upwards trending or lower or downwards trending. You could use oscillators in order to anticipate where the momentum might be diverging and we might be changing our market conditions, okay? And those of you who have spent some time listening or watching some of my videos know that we call that changing character, when that particular asset starts getting weaker or starts getting stronger, okay? And then you have a breakout or something of a breakout on the downside, okay? And that is there to help you anticipate entry and exit points, okay? So oscillators are there to give you that extra edge when you're looking for an entry and exit point. Now, the other very important factor to realize is you want to use one oscillator at a time. You don't want to overdo it. And using technical analysis, specifically using support and resistance, is really very useful when you're using an oscillator, okay? So some of the more common oscillators that we've spoken about either on the daily review or some of the webinars are, for example, the MACD, the moving average convergence divergence, where it really takes in the moving average and momentum as well to give you that little extra situation where you have a little bit one up in the entry of that particular trade, okay? The other one is when we go into something like a relative strength index. Now, relative strength before, if you've heard some of my videos before, is relative strength compared to the regular market. So for example, if you're looking at a particular stock, you're relatively either weaker or stronger than the greater market, the general market, okay? However, here it's relative strength to itself and relative strength to its own momentum, okay, which is really important. Now, stochastics are also used, and Williams percentage range is another very commonly used oscillators, okay? Now, they are very, very useful, and like I said, you want to use one at a time together with volume, support, and resistance. You want to keep it very clean, as I do, okay? Now, a few really very important points before we start as a series. Now, they're extremely useful in identifying and hitting extreme values, either overbought or oversold. Those are your entry points, okay? Now, they'll usually have a flat line, a zero line also in the middle. So they'll have a range. They have a histogram of something that looks like a just a range-bound kind of oscillator at the bottom of the screen below your chart, and it'll show you when something is hitting a certain line or it's crossing over a certain line, especially in the MACDs, for example. You'll see that, and it's really very, very useful because it's just happening. And it takes that nuance of a second for it to happen and for you to be on top of your game, for you to enter that market. Now, a divergence when the oscillator and price action is in extreme position is very important. Okay, so like I said, it's those two elements. It's price action, it's when the market is fluctuating, and it's also when those points are being met with very short time frame that this becomes very, very useful. That's the second condition. And the last one is crossing that zero line that I spoke about before is another situational setup where you can really take advantage of the market as it's happening in real time. Okay, so there are three levels here. There's the either overbought, oversold, or the middle zero line. And we'll get into it one by one as we discover MACDs, and we'll discover stochastics, and specifically how these apply to trading the financial markets. Thank you for joining us for this Technical Tuesday. We'll see you here next week.